A freelance designer has been self-employed for 22 years. She's paid Social Security taxes every year, both the employer and employee halves. At 62, she logs into SSA to check her estimated benefit. The number is $1,140 per month. She expected something closer to what her salaried friends get. The reason her benefit is lower isn't that she paid less. It's that in 8 of those years, she minimized her reported income to reduce taxes, and Social Security calculates your benefit on your 35 highest earning years. Those low-income years cost her $180 per month for life. Self-employed individuals pay the self-employment tax, which covers both the employee and employer portions of Social Security and Medicare. For Social Security specifically, that's 12.4% on net earnings up to the Social Security wage base, $168,600 in 2024. An employee pays 6.2% and their employer pays 6.2%. A self-employed person pays the full 12.4%, but can deduct the employer equivalent half on their income tax return under IRC. Section 164 Fish Crow. You pay more than an employee. You get the same benefit calculation. Social Security benefits are based on your average indexed monthly earnings, AIME, calculated from your 35 highest earning years of covered employment. Covered employment means earnings on which you paid Social Security taxes. Years with zero or minimal reported income drag the average down. If you worked 28 years and 7 of them showed $0 in net profit, perhaps in early lean years or years when you aggressively minimized income, those 7 zeros are averaged in. The formula then applies 3 Ben points to produce your primary insurance amount, the monthly benefit payable at full retirement age. The Ben point structure makes the first dollars of covered earnings disproportionately valuable. In 2024, the first $1,174 of your AIME generates a benefit at 90% credit. Earnings from $1,174 to $7,078 generate a 32% credit. Earnings above $7,078 generate only 15% credit. Translated, the first $14,088 of covered annual earnings generates roughly 10 times the benefit per dollar as the top bracket. Low-income years don't just reduce your average, they cut into the most efficient part of the benefit formula. Even partial years of modest earnings matter enormously at the bottom. The full retirement age for those born after 1960 is 67. Claiming early at 62 reduces your benefit by up to 30% permanently. Delaying past full retirement age increases your benefit by 8% per year until age 70, a 24% increase for waiting. For a self-employed person with a smaller base benefit, that 24% increase represents a meaningful dollar amount. The break-even point for delayed claiming is typically around age 80. If you expect to live longer than the average actuarial table, delay is almost always the correct mathematical decision. There is a misconception among self-employed people that minimizing reported income is straightforwardly good tax strategy. It reduces income tax, it reduces self-employment tax, but it also reduces Social Security credits, and therefore your eventual monthly benefit. The calculus is not simple. Reducing reported net income by $10,000 saves you roughly $1,530 in self-employment tax today. But that $10,000 reduction may reduce your monthly Social Security benefit by $20 to $50 per month, depending on where it falls in your earnings history. Over 20 years of retirement, that's $4,800 to $12,000 lost. The strategic approach is to balance legitimate tax deductions against Social Security credit accumulation. Report your actual net profit accurately. Use legal deductions, home office, vehicle, equipment to reduce income, not phantom deductions that obscure real earnings. For years, when your income is genuinely low, the Social Security impact is unavoidable. But for years, when you're generating strong revenue, aggressive income minimization has a retirement cost that won't appear on any bill until you're 67. Log into ssa.gov and create a My Social Security account. Review your earnings record annually to verify that all reported self-employment income has been accurately credited. Errors in the SSA's records occur. If your Schedule SE reported $90,000 of net earnings one year and your SSA record shows $0, that's a problem that needs correcting before the statute of limitations closes. The Social Security Administration corrects earnings records upon receiving proof, your tax return and Schedule SE. Check your record. Errors are more common than people expect. Spousal benefits add another layer of planning for self-employed people. If your spouse worked a salaried career with strong covered earnings, you may be entitled to a spousal benefit equal to 50% of their benefit without reducing their payment. For a self-employed person whose own benefit is modest, this can be significantly more than their own earned benefit. Coordinating claiming strategies between spouses is an area where a Social Security optimization specialist adds real value. The Social Security Administration provides no strategic advice. They process claims. Social Security is not a question you can revisit at 68 with any useful options. The decisions you make now about what income you report, how many years you accumulate credits, and when you claim compound over decades. Check your SSA earnings record annually. Understand the bend points. Don't trade a lifetime of reduced benefits for a tax saving you could achieve through other means. For the broader picture of why self-employed people retire with far less than they should, the Retirement Crisis video addresses every systemic gap. Social Security is the floor. The ceiling is what you build yourself.